So prime is a rate that is used by virtually every banking institution in the country, and it's tied somewhat to the Fed rate. So whenever the Federal Reserve issues changes their rate, which is the rate they charge banks to borrow money, then that directly changes the prime rate. So a lot of times when you're getting a loan from a bank, say conventional loan, whatever, that the money, the funds that actually went to loan closing to the seller of what you bought didn't really usually come from the bank itself. They borrowed from the Federal Reserve that money. Now the Federal Reserve will charge their Fed rate. The bank will add an interest rate cushion to it. It becomes the prime rate. I'm being very general, but that's in essence kind of a way to think about it. So every time the Federal Reserve changes their rate, that changes prime. It's the main way that they help fight inflation, cool down the economy by increasing the cost to borrow funds. So then for SBA loans, their rates are almost always tied, the interest is almost always tied to prime. Again, it's one of the main rates that are used across the country in the lending industry, and also doesn't change often. So that's another benefit to borrowers. It's not like the 1 month treasury rate that changes every single day. Instead, it's a much more solid, much less volatile rate. So that is the reason, I believe, why the SBA set prime as the rate that they want lenders to use. And then there's an add-on to that, because the cost to lenders to get the funds to then lend to SBA borrowers, there's always going to be a spread. Otherwise, it usually doesn't generate a return for a lender to waste their time giving loans. There has to be some sort of return business, right? Now, mostly it's a variable rate. Most of the time, it's going to change on a calendar quarterly basis. That's usually, and that's how we set it. That's how so many do it, because the secondary market uses calendar quarterly basis. And it's also kind of an easier way for borrowers to track. Okay, hey, it's the end of the quarter, Fed changed the interest rate, so my rate's going to go up. But usually by a quarter or half at a time. Really, usually a quarter. Recently it's a lot, but normally it's a quarter at a time. So it sets, and then what happens is then a lender will notify you, say, this is going to be your new rate, and starting the next month. And so that's now your new loan payment based on the higher interest rate, or lower interest rate if the Fed drops it.